Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In Part 2, we're diving deep into VXUS, what it holds, how it performs, and how you can use it to build a stronger, more globally balanced portfolio. Tax implications of international investments. The tax rules for international investments can be more complicated than for domestic ones. When you receive dividends from foreign companies held within an international ETF, there might be foreign tax credits available. This means you might get a credit on your U.S. taxes for taxes already paid to foreign governments on those dividends. However, the specifics vary depending on the country, the type of income, and your individual tax situation. Some countries have tax treaties with the U.S. that affect how these dividends are taxed. It's very important to note that these rules are complex and can change. For accurate and personalized advice, always consult with a qualified tax professional before making significant international investments. They can help you understand the precise tax implications for your situation and ensure you're taking advantage of any applicable credits or deductions. Popular international equity ETFs. A closer look at VXUS. Now that we've explored the benefits and considerations of international equity ETFs, let's look at some popular options. We'll start with a deep dive into VXUS, a widely favored choice for broad international exposure before touching on other notable ETFs in this space. Vanguard Total International Stock ETF, VXUS, Deep Dive. The Vanguard Total International Stock ETF, known as VXUS, aims to give you broad exposure to companies outside the United States. Its main goal is to track the performance of the FTSE Global All-Cap ex-US Index. This index includes a vast number of stocks, covering everything from large, well-known companies to smaller businesses in both developed and emerging markets around the world. One of the biggest draws of VXUS is its broad diversification. We're talking about thousands of individual stocks across dozens of countries. This extensive reach means your money is spread out, reducing your reliance on any single country or company. You'll find holdings in developed markets like Japan, the United Kingdom, and Canada, as well as significant exposure to emerging markets such as China, India, and Brazil. Beyond its wide reach, VXUS stands out due to its incredibly low expense ratio. As mentioned earlier, fees eat into your returns. At just 0.07%, VXUS is one of the most cost-effective ways to get international stock exposure. This low fee allows more of your investment to work for you over time. Its top holdings reflect its global scope. While these can shift, you'll generally see large, multinational corporations from various sectors. Geographically, it's weighted by market capitalization, meaning countries with larger stock markets, like Japan and the UK, will have a larger share. However, it still provides meaningful allocations to other regions, including Europe, Oceania, and various emerging economies, ensuring a truly global footprint. Other notable international equity ETFs. While VXUS is a top contender, the market offers other excellent international equity ETFs. Each might suit slightly different investment needs. Understanding their differences helps you choose the right fit for your portfolio. Here are a few other highly rated options. iShares Core MSCI Total International Stock ETF, IXIS. Similar to VXUS, IXIS also offers broad exposure to international stocks. It tracks the MSCI ACWI ex-USA EMI Index, which also covers both developed and emerging markets globally. Its expense ratio is competitive, often very close to VXUS, making it another solid all-in-one choice. The main difference often comes down to the specific index each fund tracks and small variations in their holdings or weighting methodologies. Vanguard FTSE Developed Markets ETF, VEA. If your focus is primarily on developed international markets and you prefer less exposure to emerging economies, VEA could be a better option. It tracks the FTSE Developed All-Cap ex-US Index, which purposely excludes emerging market companies. This means you'll find a heavier concentration in countries like Japan, Europe, and Australia, with potentially less volatility than a fund that includes emerging markets. iShares MSCI EAFE ETF, EFA. EFA is one of the oldest and largest international ETFs. It focuses exclusively on developed markets in Europe, Australasia, and the Far East, EAFE. This ETF also explicitly excludes US, Canadian, and emerging market stocks. Investors often use EFA when they want to complement a specific emerging markets fund or if they simply want exposure only to established international economies. These ETFs highlight the variety available. Some focus on broad international markets, while others narrow their scope to developed markets. Each one tracks a different index, which can lead to slight variations in their country and sector allocations. Always check the index each ETF follows to ensure it aligns with the type of international exposure you're aiming for. Constructing your portfolio with international equity ETFs. After understanding what international equity ETFs are and why they matter, the next step is putting them to work in your investment portfolio. This means figuring out how much to invest internationally and how to balance those holdings with your existing investments. Let's look at how to build a smart, globally diversified portfolio. Determining your allocation to international equities. Deciding how much of your portfolio to put into international equities, like VXUS, depends on several personal factors. There isn't a single, right, answer. Instead, consider your unique situation. Think about these points. Your age. Younger investors often have a longer time horizon. This means they can generally take on more risk. They might allocate a higher percentage to international stocks. Risk tolerance. How comfortable are you with market ups and downs? If volatility makes you uneasy, a more conservative international allocation might be best. Financial goals. Are you saving for retirement far away? Or a down payment on a house next year? Different goals suggest different risk levels. Many financial experts suggest allocating between 20% to 40% of your equity portion to international stocks. If your overall portfolio is 80% stocks and 20% bonds, then 20% to 40% of that 80% would go to international. Always assess your personal circumstances before making a decision. What feels right for one person might not be right for another. Balancing with domestic holdings, the core satellite approach. International equity ETFs fit well into a broader portfolio plan. They work especially well when combined with your domestic equity holdings, like ETFs tracking the total U.S. stock market, e.g., VTI, or the S&P 500, e.g., SPY. A useful strategy here is the core satellite approach. The core. Your core investments are usually broad, low-cost ETFs that cover major markets. For example, a U.S. total market ETF like VTI would be a large part of your core. An international total market ETF like VXUS would form the international part of this core. These offer wide diversification at a low cost. The satellites. These are smaller, more targeted investments. You might use them for specific exposure. Perhaps you want to invest more heavily in emerging markets. Or maybe you want to focus on a particular country or sector overseas. These smaller satellite positions complement your main core holdings. This approach gives you a solid, diversified base. It also allows you to add specific investment themes if you choose. You maintain broad market exposure while tailoring some areas of your portfolio. Rebalancing your global portfolio. Creating your initial asset allocation is only the first step. Over time, your portfolio's percentages will drift. Some investments will grow faster than others. This is where periodic rebalancing becomes essential. Rebalancing means adjusting your holdings back to your target percentages. For example, if you aim for 30% international equity and it grows to 35%, you would sell some international shares. You would then use that money to buy more of your underweight assets. Or, if international holdings drop to 25%, you would buy more international shares, possibly by selling some profitable domestic holdings. Here's why rebalancing is important. Risk management. It keeps your portfolio's risk level in check. Without rebalancing, winning assets can become too large a part of your portfolio, increasing your overall risk. Buy low, sell high. Rebalancing often means selling assets that have performed well and buying those that have lagged. This can lead to better long-term returns. How often should you rebalance? Many investors choose to do it either annually. Pick a specific time each year, e.g., your birthday or year-end. When thresholds are met. Rebalance only when an asset class deviates by a certain percentage, say 5% from its target. Regular rebalancing ensures your portfolio stays aligned with your long-term goals and risk tolerance. It's a disciplined way to manage your investments. International equity ETFs offer clear advantages for building a stronger portfolio. They help spread your investments across many different countries, reducing risk and opening doors to growth opportunities worldwide. Adding an ETF like VXUS can provide broad exposure to markets beyond your home country, giving your portfolio a truly global reach. Consider these investments as a core part of your long-term strategy. They are a smart way to diversify and tap into the global economy's expansion. A well-rounded portfolio includes international exposure, positioning you for greater stability and wealth building over time. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.